financial assets. The products which are traded in the financial markets are called as financial assets. So here the people where they will be making an investment is in financial assets. So what is these financial assets? Financial assets are the assets which are being bought and sold in the market. It's called as financial assets. Markets are based on the different requirements and needs of the credit seekers. The securities in the markets also differ from each other. Now here the requirement of the people or the people who are saving the money, that differs from person to person, and also that differs from, see here various constraints are there, various points need to be. Investors in the financial securities, they consider many points when it comes to making an investment. So some want to invest for a shorter duration, some want to invest for a longer duration, some want to invest in equity shares by taking more risk, some want to invest in fixed deposits. So like that, it all depends upon the type of the people, their risk taking ability, and also the duration. So here when it comes to all these people for their requirements, so there are various types of financial instruments that are being available in the market. So these financial assets which helps the investors to choose as per their requirement what is that investment they can make, and accordingly they are making an investment. So we call it as a financial assets. So financial assets are not physical assets. You can differentiate the financial assets with the physical assets. Physical assets are tangible and financial assets are intangible. And once you invest in financial assets, some security will be given to you saying that, so you being an investor has made an investment in so and so financial asset, maybe a share or maybe any units of a mutual fund, and you are entitled to be an ownership on this particular company, or you are eligible to get an interest as you buy a bond. On happening an event, if you take an insurance policy, you will also be provided a policy document on happening an event. So the as per the policy document, it will be mentioned that you are eligible to get some compensation like that. So this is called as a financial assets. It's not a physical asset. Now there are different things that we have to know relating to the financial assets. We have here call money is there, notice money is there, and then term money is there. So here when a loan is granted for one day and is repaid on the same day, it is called as a call money. No collateral security is required for these kind of transactions. Here the point that you have to know is call money is a market wherein the funds are borrowed and sold, borrowed and lent for a day time or 2 days time, not more than that. Usually who will be the participant in the call money market is the banks. So banks, if they require some temporary amount of funds, temporarily some if they have some fund shortage, immediately they approach the other bank and they get the money and they repay the money in 1 day time or 2 days time. For that, it will charge some interest will also be paid. We call it as call money interest rates. So that will be MIBAR, LIBAR, London Interbank Operation Rate. MIBAR is Mumbai Interbank Operation Rate. So the rate of interest that will be decided by the lending bank. Okay, it will be usually MIBAR. In India, it is MIBAR. So this is for temporary adjustment of funds. The financial institutions, they get a loan, and as they get a loan, which market we call it as? It's called as a call money market. 1 day, 2 days time. So immediately it has to pay next day or next other day with interest. That is called as call money market. And as I have told you that who will be the major participants in the call money market is the banks, commercial banks and the other private banks. So whichever may be the banks that they participate in the call money market. The notice money. What is that notice money? When a loan is granted for more than a day and for less than 14 days, right? It is called as a notice money. No collateral securities are required for this kind of transaction. So in both these cases, collateral is not required. What is the meaning of collateral? A surety that you have to give on the loans that you are taking. Something need to be given as a surety when you take a loan. If you give that as a surety, then we say it is called as a collateral. Whatever it may be. For banks, usually the collateral will be a treasury bills. So it keeps the treasury bills and then it will take the loans on the value of the treasury bills which it has given as a collateral. Now here also, here in both the cases, call money and the notice money, usually the banks or any big financial institutions which are participating in this type of buying and selling of this in this particular call money, notice money. So collateral will not be provided in both the cases. So what is that special about the notice money is on notice, the money has to be paid from 1 to 14 days time. So the money will be taken as a loan for 1 to 14 days time, and it is called as a notice money, right? A term money, when the maturity period of a deposit is beyond 14 days, it is called as a term money. So here we say it is called as a term loans or term deposits. So here some term will be there. A term period will be decided by the borrower or maybe a lender. So he says that I require money for 3 months time, 4 months time, a year time, 3 years time. So here that loan, whenever you approach a bank term, you want that you will be usually asked this much value of money for 3 months, 4 months, 5 months. And if at all you are making a deposit with the bank, you will also mention that the deposits will be for 3 months, 5 months, or 6 months. These we say term. Treasury bills, this also known as T bills. These are government bonds or debt securities with maturity of less than a year. Buying a treasury bills means lending money to the government. So treasury bills will be issued by the RBI on behalf of the RBI on behalf of the government. So treasury bills, whenever the government is in need of money, so it requires the behalf of the government issue the treasury bills. So these are gilt securities. They are near money, in fact. So they are equal to the money. So these treasury bills are issued by the Reserve Bank of India, and as I told you, it's a very near money. And in who will be the major investment in the treasury bills is the banks will be the major investors, and they buy these treasury bills in auction. So, and when you talk about the treasury bills, the maturity period of these treasury bills will be usually a less than a year time, right? It will, there will be a 90-day treasury bill, there will be 180-day treasury bill, and 360-day treasury bills will also be there. So these we also call it as a government bonds. Certificate of deposits is a dematerialized form, so electronically generated for funds deposited in the bank for a specified period of time. Now here, so if at all you deposit some money with the bank for a certain period of time, so bank will generate an e-certificate saying that you have deposited with the bank for a certain period of time, and that we say it is called a certificate of deposit, mentioning that so and so person has deposited some money with the bank for a so and so period of time. So this is also one of the financial asset. Next, a commercial paper, it is a unsecured short-term debt instrument issued by corporations. So corporations are there, corporations or any business houses, especially blue chip companies. So blue chip companies are the companies which are running in profits for a quite long time. They have a lot of money, well, they have so much of profits with them, and they are well reputed companies in the market. So they have a good track record of earning profits for a so long period. So consecutive for so many years, we say it is called as blue chip companies. So these blue chip companies, if they require some temporary funds for work because of shortage of working capital, they use the market by issuing a commercial papers, and these are called as the short-term money market instruments, and through which what happens is the company, the banks or the companies can raise the short-term credit which is required for their business.